You're listening to The Intellectual Investor, episode number 59, Never Let a Good Crisis Go to Waste, written by Vitaliy Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Never let a good crisis go to waste. I recently spoke to Andrew Horowitz at the Disciplined Investor podcast. He graciously allowed me to share my part of the interview with you here. We discussed this recession and why it's not like any other previous one we've experienced. We also talked about why it's the best thing that could have happened to our clients' portfolios here at IMA, what our game plan is going forward, and how we're microdosing our stock purchases to deal with the uncertainty of this time. We also chat about the assumptions we're making about the future, what stocks we're looking at right now, and what companies might not survive this crisis. Have a listen.
And our next guest is Vitaliy Katzenelson. And he is a prolific writer, loves classical music, and you can find him on what's called Contrarian Edge, as well as his podcasts of his articles and things that he's talked about, and his philosophy on investor.fm. And we've had him on before, and we have him back. Vitaliy, what's going on, man?
Andrew,
how are you?
How are you?
I'm struggling with the shelter-in-place concept. You know, I'm not really good at staying inside.
I understand.
You know,
just try to spend time with your family and just take it slow and enjoy, and just try to enjoy, your kids and your wife. And
yep. So let's talk a little bit about the, what's going on with this and a general game plan, because it's a very fluid situation with lockdowns happening, new information flowing, constant media attention. We've gotten away from all the incredible amount of ridiculous political stuff. Now it's just coronavirus alert on every station, everywhere you go. Nobody's kind of really desirous of being with other people due to the social distancing. And stocks are kind of doing their social distancing from portfolios right now, as we're seeing that markets are very concerned about the potential for what could be a cataclysmic, steep recession over the next 2 quarters. So kind of how do you deal with this?
Yeah, so originally I was going to approach this as a kind of another recession, and I realized this is the wrong approach, because what we have today, like in 2008, we basically had a run on the bank kind of issue where today we have a run on the economy. Mm-hmm. And what I mean by this, like I'll bring up Disney. We don't own the stock, but just think about my analysis, what I'm going through. In 2008, the occupancy with Sparks maybe declined from, 90% or 95% to 60%. Mm-hmm. Today, its Spark went to zero. Yeah. Its ESPN revenues went from whatever, not down 30% or 20% like they were in 2008, but to nothing or almost nothing, right? So, and if you think about retailers, you think about a lot of businesses, that's what they're going through. So in our research today, I'm spending in addition to everything else I was doing, like I was, trying to figure out if I want to be in this business. I was analyzing management. I was trying to value the company, looking at the balance sheet. Now I'm spending a lot of time also looking at liquidity.
Right.
Can this company actually, so the value of any asset is the present value of future cash flows. There is an assumption that when you do the present value of cash flows 3 years from now, the company is still around, right? Mm-hmm. So in our research, I'm spending so much more time now on liquidity. Okay, can this company, get through next 6 months, next year, maybe next 2 months? We don't know, right? That's the problem. We have no idea how long it's gonna take. But I want to make sure in our stock picking today, we are just spending a lot more time looking at liquidity. So everything else, looking for high quality companies, great management, all these things you and I talked about before, plus this. And I think actually, I'll be honest, let me just, before I sound horrible, let me just tell you the human toll, the impact on the economy, all these things. I get it. I'm not excited about that, But as a value investor, as a person who stewards somebody else's capital, I like if you came to our office today, you would see people who are smiling and happy because we are just, I think from a portfolio perspective, this may help us to actually increase our returns in the long run because suddenly there are values out there available that I can like I'm literally going to the grocery store and these avocados that used to be $6, now I can buy them as, for $1. And so I'm excited.
So, but what the problem is that you probably agree that if you find that company that has the staying power and you're looking more at the balance sheets right now or adding that in as an important component on top of the cash flow and cash flow statements and all that. But the problem is that even if you find a solid company, due to the fact of the way the markets are these days with so many ETFs and passive investments, I think you would agree that you could still have some pain on the short-term basis.
Well, first of all, yes, I agree with you 100%. Let me tell. I'm gonna give you two answers to this. Number one, any decision I make today, I expect to be wrong tomorrow. From perspective that whatever I'm gonna buy today, tomorrow I expect it to be lower. That's point number one. Point number two, it's very important to maintain time horizon that it goes beyond tomorrow, beyond 6 months. Every decision I make today, I want to look at it from 3-year perspective. Am I going to be happy that I made these decisions today from 3 years from now? But there is a point number 3. We are doing today something that I never thought a value investor would be saying. I'm microdosing. Like I'm buying stocks in small doses, microdosing. So in the past, if I would buy, let's say we have a 30 stock portfolio, I would buy 3 or 5% position as initial position, or could be whatever, 3% position. Today, I'm buying 1% position today, then 50 basis points tomorrow. So I'm buying in smaller increments. And also one thing I've been doing, because the sell-off was indiscriminate, I'm allowed to diversify a little bit more. Mm-hmm. Okay, so I'll give you an example. So in the past, if I would just buy, like I was looking at defense sector, for instance, I would buy 1 or 2 stocks. Today I can buy 4 stocks and just make positions smaller. So you kind of you're able to diversify, but there is no cost to me right now because everything is down.
But how do you? But with that, I get that, and I understand your point totally, 100%. With hey, you know what? We're going to buy a position in ABC stock. We think that this can withstand the stress, at least from what we're seeing, right? You can be wrong, but what we're seeing. Yeah. And we're going to buy that. We think the value is very, very good, and it is something that's going to be around in the future. And the price that we're buying at is a bargain compared to where this should be. Okay, put that there. Now, yes. How then do you explain this in a rational way with a client, let's say, that may be acting irrationally due to the fact that maybe they think, you know what, I do have a long-term time horizon. I'm 40 years old. I do have a long-term time horizon. However, I don't want to have to deal with this up and down. And that may say this isn't your client then. But, and then on top of it, I'm not sure about my job. I'm not sure about this. Obviously people are acting irrationally because if we thought that this is going to be a major problem for the economy, and then potentially a U or a V or an L or a W, whatever shape you want to look at from an economic and a stock market basis, and we say that we're going into a deep recession, and usually we see a 40 or 50% cut on stock prices during that time. We're only about 35% down on the major indices, small caps down about 38%. How do you then manage the client's expectations? Isn't that important?
So, yeah, no, absolutely. My job as a money manager, if I ran a mutual fund, it would be just, I would never meet my clients, right? It's just kind of, you run faceless money. Mm-hmm. I run separate accounts, and therefore I know, I talk to every single client, my firm has. So my job is to make sure that my clients also make rational decisions. And the way we do it, we have made several adjustments. Number one, so in the past, I would communicate to clients 4 times a year, and I would write 20, 25-page letters where I would walk them through every single decision in the portfolio, this kind of thing.
Wow.
So that's pretty
intense.
Yes. Today, I write to higher frequency. I write them a letter every single week. Okay, but it's not as long. So it's a depth. I'm sacrificing depth for frequency.
Mm-hmm.
And in the letter, basically, like the last letter I wrote, which actually available on contrarianenergy.com, where I actually walk them through a game plan. Okay, I say, here is how we're gonna approach this, and I try to explain what I see and how we're gonna do, how we're gonna approach them, and I try to set the expectations. And then like this, and this week I'm gonna spend Saturday and Sunday working the letter, basically walking through every position, maybe not as much in depth as I would otherwise, but explaining why I think this company is not going anywhere, why this company is worth this much, and why, most importantly, this company will be able to get through the crisis. So I think today communication is incredibly important. And there's one more point. If the money I'm managing today are not the money that people were going to use to buy groceries tomorrow.
Correct.
Right? And I think that is the key point. If that was the money, I would never take that money. In fact, if we took it, it would be sitting right now in a balanced account, and that would be sitting in basically treasuries, right? So we have some clients who have a balanced accounts where it's equity and fixed income, and fixed income literally would be sitting in six months or 1 year treasuries. Okay, so nothing is happening to that. Nothing is happening to that money. So the money that invested in equities today are the money that they need 5, 10, 15 years from now, and from that perspective, that is the best thing that ever happened to them. Really,
right,
because their returns will be higher 5 years from now because of that. And easy for me to say a little bit because we went into this with cash and we were hedged. So our portfolio still declined, but the decline somewhat less. And we have options that now became a source of cash as well. So
I get this. I mean, listen, we came into this for other reasons, not the coronavirus, because this was, let's be honest, you could have seen this, but you had to really be a magician and a fortune teller to really understand how fast this would go in the wrong direction. I mean, there was definite signs on this that there was a problem, but in the years past with this kind of thing, it never really got to here, if you know what I'm saying, right?
Yeah, absolutely.
It never got to Europe the way it was. And then once it happened, all hell broke loose, right? So one of the things that we said, and you probably would agree with me, was I have been hawking over the last year, ever since not ever since the pivot, but halfway through that the Fed artificially bumped markets and valuations were so out of whack that we came in much lighter on equity exposure for any one of our particular models, right? For anybody, if you were a moderate risk, and let's just say that moderate risk is usually a, 60-40 blend of something like that. We came in like moderate minus. We came in well down, and we didn't get that big return at the end of last year, but we're also, taking, a much less of a downside. Now, unfortunately, last week, everything got sold, right? It was a bad week for everything. I don't care if you had bonds, if you had stock, it doesn't matter what you had. Gold, everything was sold. Let's not even talk about commodities. But I guess the point now is, now that you have some dry powder and you have the opportunity to invest with the knowledge, I think that you believe that this is going to be a pretty rough go around for the economy and therefore stocks. What you're saying is your game plan is to dollar cost average, or you call it microdosing, into the portfolio in the names that you really like. What's going to happen if one of the names, I don't know why, things happen, right? If this goes on longer and you're like, you know what, maybe we were a little off on our calculations on that. That's part of the play, right? To constantly review?
Oh, absolutely. I think you need to be able to change your mind, right? And I think and as this is evolving. And today, like a part of the analysis we're doing, we're also looking who are the customers of the product that this company makes, right? So if you are on the healthcare side, for instance, customers a lot of times are basically government or insurance companies, right? Or I feel somewhat okay with that. If you're buying defense stocks, I'm talking about the companies that make weapons, the government is the customer. So I feel fine about this. But if I'm buying something in a travel, like let's say hypothetically, I'm buying something in a travel space.
Boeing's the perfect example. Even though they have defense, the customers of Boeing are the plane manufacturer, airlines.
Yeah, exactly.
Yeah.
So that becomes a lot more difficult, right? And so we are looking, for instance, we are looking in a travel space, but we're not looking at airlines because it's just, so one goal I have, after all this is over, I want to come out with that, with businesses I would like to own, in the normal environment too. Like, so I'm not a big fan of airlines in general. So when this is the reason I'm not touching airlines, because this is not the businesses I would want to own in a normal environment.
Right. What about cruises?
I'm sorry?
What about cruise lines?
Yeah, it's the same thing. I mean, they are just, if you analyze the business very carefully, they never make any money. I mean, they depreciate their cruise ships over, 30 years, and they, the real life of the cruise, is not really, the ship is less than that, because, who wants to take a 30-year-old ship? So you need to keep upgrading it all the time. So this is now, but at the same time, and we haven't bought it yet, but we spend a lot of time analyzing online travel agencies, right? Because that is actually a phenomenal business. It's asset light, high return on capital, and that's the business will get impacted, right? Because today their revenues are probably zero, which is fine. But if they have good balance sheets and they can get through this, at some point, like, you have to make an assumption that the life will continue at some point, like the normal life.
Right, so you're talking about like a company like potentially like an Expedia or a Bookings.com, that kind of thing.
Exactly.
Okay.
Yes. So
that would obviously pick up first, because they'd be the first thing that will happen was people, when they go back to traveling, is they're going to use some of these services to book it, even though travel is 4 months in advance.
Exactly. So yeah, and they have, those are good businesses in general. Like we spent, actually, it's kind of funny. In January, when the coronavirus thing started to happen in China, we spent a lot of time looking at these businesses, thinking, okay, well, and I'll be honest, I'm somewhat embarrassed now for this. I was thinking this is more like a China problem, and maybe more like Chinese going to Europe problem.
Right. No, you shouldn't be embarrassed. I mean, that's what it was.
Yeah, no. So our analysis was, well, their business will be down, and the stocks will decline. What price do we want to pay for them?
Right.
And so we spent a lot of time analyzing them, and now this research actually becomes very useful, because we know what we want to own at what prices. We may have to readjust our pricing a little bit, which is fine, valuation a little bit, but that's fine. But we've done most of the work in January. So that's how I'm looking at this. I think quality, here's the thing. When you and I look at this, how this is going to play out, the outcomes are extremely wide. This thing could be over in 3 months. That's one of the probabilities. Mm-hmm. This thing could be over in 6 months or a year. And the longer it lasts, the impact is not like, let's say, impact of 6 months versus 3 months is not twice as bad. It becomes exponential. It becomes a lot better. A lot more. It becomes 5 times more bad, 5 times worse. And the reason for that, because you're going to have it's going to start trickling through the credit. So the banks start having huge problems. So my thinking is, so this is why every decision I make today, I would err on the side that's going to last a year.
Oh, don't say that. It got me in the eye. That's not good. I mean, the truth is that some of these companies can't last 3 weeks, it seems.
Well, that's my point. So I would because I'm managing somebody else's life savings, and you are too. So I would err on the side of that may last a year. And if I'm wrong, you guess what? I'm going to make him less money. But you know what? I'll get through that. And my clients will be happy that by the amount of risk we took.
So in terms of this order of magnitude increase in risk, the longer this goes, I think we all are aware of that. One of the problems, tell me what you think about this, because one of the problems has been everybody's like, credit is cheap, or bonds, debt is cheap, and companies are buying this debt, or not buying, they're issuing the debt, and people are buying it up like crazy. There was like nonstop, insatiable appetite to buy this debt, right? I mean, and that's because you got the sovereigns involved, and I am certain that all the sovereigns sucking up all the debt around the world and the pension plans sucking up all the debt because they have to meet their numbers, and the low interest rates are a big reason why we're that much worse off. Because think about this, it's very simple, right? If you own your house outright and you lose your job, not as big of a deal if you own your house, but you have a massive mortgage on it. And even though the cost factors right now are low, corporations issued more debt than ever, not to mention the sovereigns, right? And we are going to get ourselves into a credit problem because if you don't have the cash flow, it's a Ponzi scheme, let's be honest. And if you don't have the cash flow to keep this thing going, you're going to start digging into your balance sheets and you're going to start really having some problems with any cash that you have on the books. That's why a lot of these oil companies, with the oil prices down, then double hit with this, the problem with demand are just, obliterated. I mean, are you looking in the oil space?
Yeah. So let me make two. Like, I'm gonna answer the oil question because I want to make a very important point. I think our economy, in general, and our companies have been maximized for efficiency, not resiliency. Right.
Exactly.
Because the good times continued for so long that why would we care about risks? There are no risks, right? And when that happens, you have a lot more leverage. So I was concerned about that. And so one thing we did actually, which I hope when we were doing it, I hope it would never work out. We bought puts on corporate bonds ETF, LQD.
Mm-hmm.
And that thing just, and we're far of the money. And then, I never thought it would make money on this. I hope we wouldn't. But now it's one of the sources of returns. So, but I think the point you're making is so important because we did tax cuts 2 years ago, on the economy that was growing on a very an economy that was in its prime, right? Okay, so we're cutting rates when the economy was doing okay, and so we are basically trying to stimulate a very healthy, somewhat healthy patient. And now when
it was steroids. It was steroids.
Exactly. And so we are steroided, and now we need to spend trillions of dollars to get through this. So this is, so that's point number one about oil. So we bought an oil stock in December, and I wrote about it. And my thinking at the time was, the oil prices had been low for so long, and the shale producers kind of were shaky because a lot of them were losing money and levered. That at some point, most likely, we're going to have the supply will decline, and oil prices will go up just because kind of low oil prices will cause high oil prices. It's kind of but when we were making the decision what to buy, I erred on one of the highest quality companies out there. We bought Equinor, which is basically a Norwegian oil company,
mm-hmm.
which used to be called Statoil, which is Norwegian. Basically, Norway has $1 trillion fund.
Yeah, sovereign debt fund. Yeah.
Yeah, that's where it's coming
sovereign
from.
Wealth fund.
Equinor is the source of that. So, and our thinking was, if oil prices go up a lot, this thing will go up, and it's probably may not be as much as the riskier companies, but it will. If oil prices stay here, we're going to collect 6 or 7% dividend, and production is still growing. And if oil prices decline, they'll be the last man standing. Mm-hmm. And so this is kind of our approach to this. So, so when the oil prices declined, so this company will probably going to cut the dividend. I have no problem with that. Okay. But the one thing about the low oil prices today, I think actually it's very beneficial for oil 6 months from now, a year from now, because these low oil prices destroy supply.
It takes out the frackers, it takes out the drillers, and therefore what you're saying is, I'm going to go to the end solution here, or end of this discussion, is that there's going to be a lot less potential supply coming up. And then if demand comes back online, oil prices go up dramatically.
Exactly. And you want to own the last man standing. So there's Nassim Taleb, wrote this book called Anti-Fragile. And he talks about the three types of companies: fragile, robust, and anti-fragile. Fragile companies are would be the shale companies today.
Mm-hmm.
Robust companies would be companies would come out okay, but would not necessarily benefit from this. And anti-fragile, the companies that basically end up taking come out, they're robust, but they also will take market share, and they'll come out stronger. So Equinor is somewhere between robust and fragile. Or anti-fragile. They're probably closer to robust. Other companies we are looking today, we are asking, okay, is this the company when this is all over will come out, like will benefit from the crisis? And I'll give you a name because we started to nibble into Berkshire Hathaway. Warren Buffett has $120 billion of cash. He's basically kind of became the corporate lender of last resort.
Mm-hmm. You wonder if that's what he was waiting for.
Exactly.
Because he hadn't done any acquisitions in forever.
He was criticized 2 months ago for having this much cash. Warren Buffett lost his touch. I love those articles. And in reality, this $120 billion of cash is probably worth double or triple that after this is over.
But isn't that exactly the problem? Investors have been rewarding companies that were, and I've been talking about this for so many years, I can't even tell you, rewarding companies for their share buybacks, which effectively we know, you and I, that is a form of financial engineering for the benefit of earnings and keeping stock prices afloat, and not keeping cash on the books, because people that had cash on the books, like Apple forever was valued at a much lower multiple because of all the cash they had, till people said, oh, let's buy Apple anyway. And Berkshire, the same thing. And, you look at a company like Apple, and while their sales may decline significantly, and while, who knows what's going to happen with the entire situation, they still have bukus of bucks on the balance sheet, right? That can allow them to pretty much skate through anything.
Well, so let me agree with your first point, and we'll come back to Apple in a second. So I agree with you 100%, and I think it really comes down to the management, right? If you have, if somebody is let's call them professional management, who is there to maximize shareholder value, their time horizon is measured in quarters, right?
Right.
And therefore, they're not thinking about resiliency. They're just thinking about their paycheck that's tied to earnings per share, right? Which is very short term. If you have somebody who is own operator who owns a lot of the stock, then suddenly if they own 10 or 20% of the company, suddenly their time horizon is different than just from professional manager, right?
Mm-hmm.
This is why, to me, it's incredibly important to see, to understand the management, And so when we analyze management, we look at two things: how well they run the business and how well they allocate capital, right? So that answers your first point. So I agree with you 100%. Let's talk about Apple, actually. So Apple, I just looked at it a few days ago. Apple used to have a net cash balance sheet, like by hundreds of billions of dollars. They have a few $1 billion left of net cash. So they can weather the storm because a lot of their debt, has long-term maturities. But this is a company that have bought a lot of stock over, that had to basically, they have as much cash now basically as they have debt. So even Apple, probably spent maybe too much money on buying its stock, and so I wish they had more cash so they could take advantage of the potential weakness in their stock price. But
the problem here has been also not only the corporate, the mindset of the corporations on the quarter-to-quarter deal, because that's the only way they could really appease investors, but the activists too. I mean, I'm really kind of coming to the point that, and I've always had this, but you know what? These activists who were just in there to figure out how to manipulate whatever was going on, and some of that may be good, but it was always down to the bottom line of, hey, how can I get the most out of my shares here? Which is not a bad thing. You're an investor. That's what you should be doing. But to a point that they somehow wowed and mesmerized management to do things that they should have never done.
I agree with you. So it's I don't want to put all activists in a bad category. It really comes down to the time horizon, right? If you're an activist and you're just trying to create a pop in a stock and then be out, you're probably going to cause damage to the company, right?
Right, exactly.
But if you're an activist and you come to the company that has been mismanaged, right? And you are turned around and you're willing to stick around for a long time, then it's a good thing. I mean, I'll give you an example. In Canada, there was a railroad. There was still a railroad called Canada Pacific, right? Mm-hmm. And activists brought a new management team, which really have improved the railroad as a business. And it's, because of the activists, it's a much better company today than it was before, So activists can create value, but at the same time, that activists stuck around for a long time. And so he was basically a long-term investor who changed the governance, right? So activists could be good force and bad force. So I don't want to put everybody in the,
So how about we do this? We'll call the activists that are looking at bettering the company, the management, the structure into one category. And then there's the activists that we'll call a corporate raider. That is the ones that are looking to really just make a quick pop by maybe cutting some parts of the business, gouging maybe employees and just doing it for the next 6 months or 1 year.
I agree with you 100%, and that's yes, absolutely.
So now, you wrote this article called "The Impact of Coronavirus, People, Economy, in Your Portfolio," and I think we agree that we're because we talked before, but that this is going to be, in our lifetimes, probably the worst economic event due to this way this is structured. My concern is that it's going to leave a lasting imprint on people, not just investors, people, to a point that, almost like this is kind of like, you're being in war and you're coming out and you have a depression and a constant reminder every time flu season comes around that you would be shocked, shell-shocked, and almost have a PTSD kind of situation going on. Now we are resilient, and economies are, people are, et cetera. We all know what we have to be doing right now. And in the end, you look at some of the other things like the annual flu rates and what's going on there, and how many people die on a regular basis from obesity or lung cancer or whatever it is. I don't know if we're going to get to that point. If we saw the spike in Italy at 8% mortality rate for this and how much more that's going to go. But shutting down the economy is the equivalent of what happened during the Depression, isn't it?
It's a war. It's like I'm treating this as a war. So this is a very interesting topic, because we as the United States have never really had a war on this soil, right? You can say 9/11. I'm not talking about civil war. I'm talking about being attacked by a foreign entity.
Right. Yeah.
You can say 9/11 was probably as close, Pearl Harbor kind of, but Hawaii was not really part of the United States then yet. But anyway, we really never had a war on this soil, right? And therefore, we've been spoiled, right? Because we have we got two oceans on different sides. We got Mexico and Canada, so we kind of very, it's a good thing, right? We had a huge comfort for last many hundreds of years. Okay, now, if you look at countries like Israel, for instance, right? And my son just came from Israel, and he was doing an internship there. And Israel basically always lives in the state of war. So the relationship the government of Israel has with its people is a democracy, but it's a very different relationship that we have with our government. Israel basically right now on the martial law, not quite, it's basically on lockdown. So my son basically was told, you can go to the store and that's about it. You can't even go to the park. So, they want you to stay at home. And people said, well, people trust the government that this is a wartime, and that's what we're doing. So the way I'm looking at it, the way I'm looking at the coronavirus today, which is actually very different than it was 2 weeks ago when I wrote that article you're referring to. The article was already obsolete because so much changed in my mind. We are at war, and we need to go on a lockdown. And the reason we need to do this because if we basically contain the spread of the virus, and we're basically going to buy time. There is a cost to the economy, but that cost is going to be so much smaller if we don't do this. But the reason we need to buy time because it's one of the two things may happen, maybe three things. Number one, the drug companies will come up with a cure.
Yes.
That's number one. And I'll tell you this, capitalism, this is the time when you want to praise capitalism. Okay, yeah. Even though government is sending out checks right now, which is anything but capitalism. Okay, but at the same time, the corporate America, the one, corporate, I guess, corporate Europe as well, I guess, they're looking for cure 24/7. So, and I'm sure they'll find a cure. It's the question when. Then second thing is that even if we don't find a cure very quickly, testing has been incredibly successful in South Korea. And testing can actually, if we, in 2 or 3 weeks, if we have enough testing to start testing everybody, that could be a huge solution. That could be very beneficial. And third, and this is where this is more like a hope than anything else. Maybe the sun will cure this. Who knows? So my point is, we need to buy time, and I think the lockdown is necessary. And I think we are probably days away from having a kind of almost like a martial law.
Don't say it. Don't say it. I don't want to hear it.
Oh no, this is like what's happening in California is going to be across the whole country. So I'm.
Well, then
and you know what? And that's fine. I want us to overreact, because here's the problem: we are so used to bad things happening to somebody else, but not us, that we are underreacting. So you and I'm guilty of this. I was looking at China and say, well, these things can only happen in China. Well, we were wrong, and so I'm.
The question though is, if you shut everything down, or at least non-essential, which I'm not exactly sure what that becomes, and if people have an office somewhere, if they're the only person in the office, if that's okay to go to, or if it means that I don't even know what the exact definition of shut everything down. If it's just public meeting places that clients can go to, that people could eat, the economy goes into a free fall, and restarting that is like trying to restart a diesel engine that has been running for the last 50 years, and you turn off for a while, and then you got to do a lot of cranking to get that going again. So that's a great question. So I compare this to when 2008 was running the bank, this running the economy, and the government today, is kind of playing the role of Federal Reserve, and it's basically saying we're gonna provide money. So you and I, like people and the wealthier people, can get through this, fine for a certain period of time. Lower income people who are going to have a hard time doing this, right? So government coming in and basically giving people money to survive for the next 2 weeks or 3 weeks or month, whatever, will dampen the effect of this. However, there is a cost, right? And it's going to cost trillions of dollars, and that changes the equation of what's going to happen. We're going to have inflation and deflation, right? So there is a cost that we're going to have to pay for that at some point, right? But that cost is still so much, that cost is still so much smaller cost if we don't do this, right? You know what I blame? Can I tell you who I blame part of this problem on right now? It's the Fed. And I know that I was like, what do you always blame the Fed? The Fed's move last year, because we saw that stock market tick down. Yeah. And they did a pivot, and they could have just done a pivot without any rate decreases.
Absolutely.
And had a lot more powder, but somehow I don't even know what they were thinking, because what was on the horizon really was nothing. A little bit of a tick down in the GDP and all that. There was no reason for them to stimulate at that point. They would have had 0.75%. You know how much that would have been usable and useful for in this environment?
Listen, I can't argue with that. I mean, I think you're right, and I think it was a political move than anything else. However, so I wrote this article that you're referring to, about coronavirus, and I wrote it almost 3 weeks ago now. Mm-hmm. And I look at this article, and there was one underlying assumption, and I was basically saying expect recession. Mm-hmm. But I was wrong in a sense that I was basically saying that this is not going to be as bad as China. And my argument was we have a lead time, and we have a lead time. And so therefore we can react fast. China showed us how bad it could look, and our government will react, and we'll be fine. Etc. It's not going to be as bad. I was wrong about the government response. The government response was so inadequate, and I think this is why. So this is where every minute, 1 week of time now is very expensive. So I think now government was underreacting, and now hopefully it looks like they are overreacting now, which is fine with me. Like I would rather.
Yeah, I mean, you look
overreact
at the Chinese stock market, and that didn't take as much of a dip as ours did.
Absolutely.
I mean, it was actually pretty darn stable. I mean, it took a little bit of a dip to begin with, and it wasn't as high as ours was to begin with. That's why I think we had to deflate all that excess from last year, which was my initial plan. We would deflate that. I didn't think it was going to go, like I said, this far, and that's why we came in so light on the equities. But so, with that in mind, I think what you're telling me is that you're still confident that you can find great bargains, whether it's sector-based, individual equities, et cetera, lightening up on the new buys, right? Because you have a portfolio of positions already, but lightening up on the new buys, okay? And then looking out at this thing a couple years down the road, however long, and realizing that this too shall end. Is that the point?
That's exactly actually one of the exactly. So we were positioning for recession. Our portfolio was positioned as if recession came tomorrow. Obviously, we did not position for coronavirus, and this is kind of an advanced version of recession, a slightly different recession. But yes, I'm basically saying I'm making decisions 3 years from now. Like think about March 2009. That was the bottom of the market, but it was anything but the bottom of the crisis, right?
Right.
Like or at least you could not tell, right? At the time, you would read headlines and they were as scary as the ones, a month before, the month after. So you could never, it's incredibly difficult to time the market. And the way I look at this, as long as I am buying businesses that will survive and strive 3 years from now, that is the best thing that happened to my clients' portfolios. Not to my clients, but their portfolios.
No, I get that. I get that.
And I want to stress this point because it's so, I don't know if you can hear my excitement.
I hear it.
But I hear it. But it's really, I'm really, as a portfolio manager, this is I actually, I'm working 12-hour days right now because there are so many stocks I can look through now and say, oh my God, do I want to own this great business at this price or the other one?
Yeah.
However, there's one caveat. The market declined, 30-something%, and there's still a lot of very expensive companies.
I do know that. I know that. And, it's funny because, like I said, we look at our positioning and as light as we were, and I also tell you that I've gotten in over the last couple of weeks, a lot of people asking me to review their portfolios because we did this special birthday. I did my birthday's today, actually.
Happy birthday.
Thank you. I'll remember this one. The thing is that we ask people, hey, do me a favor, send in your portfolios for this month for my birthday. I'm going to do free portfolio reviews, and that's available over on thedisciplinedinvestor.com. Click on the Ask Andrew, drop it down, and you can do a secure upload of your portfolio. And I can't tell you how many portfolios that I've seen that are absolutely decimated. Somebody had $103,000 on December 31st, let's say, and they're at $58,000 now.
We had a person who reached out to us, a month ago, and it was a $500,000 portfolio. Our minimum account size is $500,000, $500,000 portfolio, and then she called us up and said, "I can't. I was levered and I lost my money."
Oh.
So this is very unfortunate. But also, this is basically, I think, part of the reason why this move in the market. There are many reasons why the move in the market was so violent. But a part of the reason was, there are so many people that were forced into equities. And this is when you say blame Federal Reserve. Yes, blame Federal Reserve for that. Because people were hungry for any yield. People were hungry for any return. Right? And the bonds did not offer that. And so what happened basically, everybody, and you and I actually, Andrew, if you look back at some of our discussions a few years ago, you and I had this discussion.
Yeah.
Where I basically said everybody was forced to take more risk. And I was, so you and I had to take a career risk because I said, I'm not going to do this. I just, and so I'm taking career risk because I'm going to say, I'm going to have a lot more cash and we're going to err to own companies that I don't have to worry about their valuations being cut in 70% and they're not seeing that valuation ever again. So I think this is exactly why the move was so violent. And I think for those expensive stocks, it's still not over.
I would tend to agree with you. I mean, the thing is, there are some companies that are quote unquote expensive that still probably have some great value. Microsoft, whether it's exactly expensive now or not. Microsoft is solid. I mean, they have a lot of components to it. They have a solid company. Even though you may have less seats that you're going to be utilizing and paying them. I mean, can we find fault with Microsoft? There's no replacement.
No. I actually I haven't looked at Microsoft in a while. We used to own it actually a long time ago. My only point there would be, so as you talk about the business, I would argue Microsoft business is going to be stronger 3 years from now than it is today. Okay, so however, the question is, what is Microsoft value? The value of the business. So was Microsoft business overvalued today, and therefore, in the 99, Microsoft was still a great company. But the stock has gone nowhere for 10 years because it was still a great business and growing, but the stock was just too expensive, right?
Yeah, right.
So I think this is where they are, this is where the issues are. There are some great companies. So the investors were making kind of a one-dimensional decision a lot of times. They would say, this is a great company and I want to own it. But what they did not go a step further and say, this is a great company, but is that a good investment?
Right. No, I hear you.
There is a difference. So I'm not, if I own Microsoft, I can't even speak about Microsoft because we haven't valued it in a long time. So
again, just an example. But anyway, I encourage everybody to check out Vitaly's site and go over to either investor.fm or just look up Contrarian Edge, and you can find out all sorts of information. We'll have the links to get there over on the Disciplined Investor on the episode for show page or show notes page for number, what are we at? 654.
Oh my God.
Yeah, I've been doing this since 07, my friend.
Oh God.
07.
Well, that's why you're so good.
I don't know about that.
No, you're very good. Yeah. No,
I appreciate it. Listen, you stay safe. Hugs and kisses to your family, and hopefully we'll meet on the other side. You know what I'm saying? Absolutely.
We'll talk when it's over, and we'll look at this as a interesting time.
Yeah, exactly. All right, buddy. I'll see you soon. Thanks.
Thank you.
Thank you for listening. This and other investment articles by Vitaliy Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaly's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.